another part of this meme stock saga, the initial kind of scandal around it was not only what was happening on Robinhood's platform with some of the names going down, the platform kind of breaking on a daily basis, but also the hedge funds that had been betting against names like GameStop and the losses that they had been suffering. We saw the short interest in some of these names exceed the entire float at one time. Very odd things going on within the market. And a company that was really at the center, remains at the center of tracking all this, is S3Partners. And joining us now to talk about where things stand with some of these meme names, Ihor Dusaniwsky joins us. He is the managing director of Predictive Analytics over at S3. So, Ihor, we just got reports, in the last couple of days that Melvin Capital, who is at the center of this, continues to take losses on some of their positions. But as you guys look at the data on short interest related to a lot of these hot names, is it still elevated? Are people still out there trying to take the other side of this, or has everyone been scared off by, some of those grisly numbers that we saw back in January and February?
Yeah, hi, thanks for having me. And, you're right. There is a lot of short covering in a lot of these names because the losses have just been so big on the short side. We see GameStop down to over $6 billion. GameStop short sellers down over $6 billion for the year. AMC short sellers down around $4 billion for the year in mark-to-market losses. So, there are a lot of shorts that are getting out of their trades, especially in AMC recently. We've seen some 29 million shares covered over the past week. And, that's over $1 billion of short covering. So, when you talk about meme stock, kind of hand in hand goes short squeeze. And that's one of the things that the long shareholders, retail shareholders are looking at some of these names.
Ihor, as someone that has been covering this so closely, how would you define a meme stock?
I think you guys hit the nail on the head with your earlier talk about what is a meme stock. When I look at our data and data on the street, I really look at the total short interest. I'm looking at recent profit and losses on the short side because that volatility of pricing really does affect how the retail traders trade on this name. If they're seeing a lot of activity and upside moves, they're going into the name stronger because this is kind of a social thing where it's retail versus institution. So as the stock price goes up, the idea that the hedge funds are taking losses is actually putting fuel in the fire.
But Ihor, I am curious if you can sort of suss out through the data if that is in fact still true, because there's also this line of thinking that there are now a lot of hedge funds on the long side also that are trying to profit from this. Is there a way of seeing through the size of trades, for example, what's retail and what's institutional here?
Yeah, when I see 500 million shares traded a day, I'm looking to myself and saying, well, that's not retail guys alone. There's a lot of institutional guys that are day trading during these market volatility and making money intraday buying and selling stock because you just don't have that many assets on the retail side to make up that trading volume. So we are seeing a lot of institutional longs playing alongside this because these guys are smart. They realize that some names are fundamental based, some names are more momentum based. And if this is a momentum-based name, then I need to trade in that way, and basically, go in and out of a name as prices move and technicals show me how to trade it.
Yeah, and Ihor, finally, just thinking like longer term, what this means for the markets. Short squeezing is not new in any way, shape, or form. That has been around for a long time in the market. The way that retail has jumped into this is a new development. But do you think that this changes the calculus around people seeing short interest as an opportunity? Is it something that's more exploitable for institutions, less exploitable? And how does this, maybe in your view, play into just the data sets that people go through to try and find ideas going forward?
Right. I mean, the name that surprised me this week was Wendy's. It doesn't have a huge amount of short interest. Yeah, and I saw that it was turning into a meme stock. And I figured that, this might actually curtail it and kind of fall off the map just because there aren't that many shorts in the name. It kind of misses out on the high short interest piece of the puzzle. What I do see is more and more longs and shorts looking at the short squeeze potential of a stock. And they're trying to see, is a short crowded? And, is there a lot of short interest? Is it tough to do a stock borrow? Is it tough to get a locate? Is trading volumes, not support the amount of short selling in a name? Overall, if there are 10 million shorts in a name, but trading volume is 1 million shares a day, well, this is a crowded stock. You can't get in and out of the name, and that's why we created a crowding score and a short squeeze score that is basically identifying to both long and short investors what stocks have the propensity for being squeezed and what stocks are crowded on the street. And I think these are names that people are going to be investing in both on the long and short side, because this is a momentum market in a lot of these stocks.
And then, Ihor, without opening a whole new can of worms, certainly the way that stocks are owned now with ETFs versus active individuals and what stocks are available for borrow. And as you look at the market, has that changed some of those dynamics around how easy it is to cover position, find a borrow, and get that done at a reasonable price?
Most of these stocks are borrowable, so you can get a locate and you can't put on shorts. I mean, there are certain stocks like Clover, which is getting a little more difficult to borrow at times. We've got most of the names that are able to shorts to get in and out of a trade. But yeah, you're right. If there's a lot of institutional holders, it means that there's more lending ability in the name, and that means that shorts can get into the name. So a stock that didn't have a big institutional holding before this meme stock, it became a meme stock, and now does, actually helps the shorts get into the stock.
Right, because you want to know why your fees are so low on some of those ETFs. Well, we're finding out some of those details on how people make money around the edges of their portfolios with all this stuff. All right, Ihor, thanks so much for jumping on the program today. Ihor Dusaniwsky, Managing Director of Predictive Analytics at S3Partners.